All right, let's have a look at this principle of Gaap. Gaap standing for the Generally Accepted Accounting Practice. Now, these are common accepted practices that the accountants use out in the business world to try and get conformity so that businesses will be reporting in exactly the same way, and therefore there can be a comparison between businesses. It's important to know that these are not laws. There's always going to be situations where they can't be so strictly applied. Different from a legal thing where it will be this. I mean, your tax is a fixed laid down percentage. You will pay a certain percentage. Whereas this is what the accountants will try to stick to in making the entries in the financial statements. Now, a lot of learners see this as something that we may just learn. And it's a theory question, and like this question here, that 6.4 that you're doing, where you just match it off. But what you need to understand is these are the principles that we use to guide us when we are making adjustments or we are making entries in the book. So if you see something and you say, well, I don't know what to do here, the principles should guide you. And I've used this in many cases. Just before this lesson, I spoke about provision for bad debts, and I spoke about the principle that it was prudence being realistic. It was the principle of prudence that told me what I needed to do. So now let's just quickly go through these. You are going to do this task where you're going to look for a description and you're going to look for examples. But just let me explain it. The business entity rule. This is the business and the owner must be kept separate. So the business and the owner have to be kept separate. If you are saying that the business has made a certain amount of profit, those need to only include business expenses. You cannot put the owner's private expenses through and distort your net profit. You've already been doing this right from grade 9 when you spoke about drawings. Anything of the owner's personal use went through a drawings account. If you get an entry in bank recon and it says that a check was put through the business account, but it actually was for the owner, it can't be treated as a business expense. It has to go as drawings. The historical cost rule. Now, these two over here, I just want to bring these two together. The historical cost rule, history, the past, tells us that we must always enter at the price we pay. So, I might have bought land and buildings 10 years ago and I paid 200,000 for it. The historical cost rule will dictate that that land and buildings will be in the books at 200,000, even though it might have increased. If you get a trade discount, you go and buy goods for 1,000 Rand and you get a trade discount of 10%. The historical cost rule will say to you, you must put it at the price that you've been charged. So it's not 1,000 anymore, it's only 900. All right, now we get a contradiction with this rule of prudence. Now I'm going to talk about prudence first, and I'll tell you what the new concept of this is. Prudence says to us, you must be realistic. So now let's take an example of vehicles. The historical cost rule says I must put my vehicle in at the 200,000 that I bought it for. Prudence contradicts that, and it says no, you must be realistic. That vehicle is not worth 200,000 anymore. Now in this case, prudence will take preference over the historical cost rule. And this is why I said to you, there can't be laws, because they can't apply all the time. The rule of prudence says be realistic, so we would depreciate our assets. If we had to revalue our trading stock at cost or below cost, we would put the entry through, even though we might not have sold it at that time. It's prudence as to why we wrote off a provision for bad debts. Now, under the new Companies Act, and it's not really relevant in our school syllabuses, but this has been replaced by what we call fair representation. And this is taking preference in the world accounting records now, that everything must be shown at a fair figure. So now if I go back to the land and buildings, the historical cost said 200,000 and we left it at 200,000. If you are working with fair representation, which learners we do not do at school, you would revalue those assets at a realistic figure. If you were writing off depreciation, well, these two would mean the same. Show a fair representation. That is why we've depreciated it. So that when people are using your financial statements to determine and make decisions, they have got fair, realistic figures. The matching concept. You match. You are all matched in a class. Your class is all made up of accounting students. You don't have accounting and history in the same class. You are matched. Now, from an accounting point of view, this is where we match up our income and our expenses to the correct year. So if I told you that you had paid electricity of 10,000, but another 1,000 is still owing, you're going to match. It's an expense for this year, so you would add it on. And because you hadn't paid it, you'd bring in your expenses payable. Those four accounts, your income receivable and deferred income, your expenses payable and expenses prepaid, is applying this matching concept. You are saying what year is the expense and income relevant to. Not when you paid it or not when you received it, but what year was the expense incurred or what year did you receive the income. The concept of materiality. Now this word materiality means, is it important? So often in a court of law you will hear this is material evidence. It's important evidence. Now if something is important in our books, we must show it separately. That is the reason why interest on overdraft is not a bank charge. Because it is important to know what our interest is costing us. Because we have to make decisions whether it's viable. It's an important concept. And so we do not lump it into bank charges. We keep it separate. In your partnership exercise that you're going to go on to, when you start paying off the share of the profits, it is material to say how much of that is going to be a salary, how much is interest, and so on. So when you get your partnerships exercises, remember this materiality concept. If something is important, it must be shown as that. And then the going concern is probably the only concept we don't use at school. A going concern means this business is going. It's carrying on. The opposite of a going concern would be a business that is closing down. Now at school level, we don't deal with businesses that are about to close down. If you were, and you would do this when you leave school, then your assets have to be revalued at a price that maybe you would be able to get for those figures. It's no use saying that your stock is valued according to this at 100,000. But if you're having to sell it off quickly, you might not get the full 100,000. So then, if it's not a going concern, you would have to revalue your assets. Any business that is going to close down is going to have to look at their financial records. A mine, for example, a mine only has a limited lifespan. Depends on how long those minerals are there for. So it would be a going concern only up to a point. And so when you're using this concept in the case of a mine, if you look at the mining equipment, if you think this mine is only going to operate for 5 years, then you need to write off that equipment over 5 years. It'll bring in a different concept. But as I say, in school, all our businesses are going to be going concerns. We do not work with closing down businesses. But however, you need to remember that as a concept when you're applying your principles. So learners, I don't want you just to learn these as theory. I want you, as you start moving into adjustments into your financial statements now, the partnership, I want you to go back and see what rule or what principle is telling you what you need to do.